Good day, everyone, and welcome to the premium video newsletter for Wednesday, September 4th, 2013. Lots to discuss today, so let's jump in and start off with the fundamentals. The big story today was slightly bearish news in regards to international trade. The U.S. trade deficit widened in July from a four-year low in June. American consumers bought more foreign cars and other imported goods, while U.S. companies exported fewer long-lasting manufactured goods. A wider trade gap can slow economic growth because it means that U.S. consumers and businesses are spending more on foreign goods than U.S. companies are earning from overseas sales. However, the decline was extremely modest. And since the June numbers were surprisingly strong, the market did not put too much weight on the negative. Automakers reported sharply higher sales for August, putting the industry on track for its best month in 6 years. And the Beige Book survey, which is a Federal Reserve survey, showed all 12 of the Fed's regional banking districts reporting modest to moderate growth. That's roughly the same as the Fed's previous survey for those districts from late May through early July. The U.S. stock market is looking ahead to Friday's non-farm payroll at this time, when the August jobs report will be released. Economists polled expected the U.S. created 177,000 jobs last month, and that unemployment rate held at a steady 7.4%. Friday's job report is the last important piece of economic data the Federal Reserve will have to work with before the central bank decides later this month whether or not to pull back its bond buying program, which has kept interest rates unusually low. Most investors believe the central bank will begin to pull back. The question now becomes when and how much. Technically, today we saw the first step the broad market took to show us that we may be getting back to a bullish trend. The gap that was made on a breakdown between 1652 and 1656 level was filled today. However, we're still below the 50-day moving average. So until we get up there, I will not consider the broad market to be moving upwards. Also, keep in mind that the stock market is looking ahead to see what Congress will do next week in regards to Syria, and equally importantly, the Friday's payroll data. So don't think we'll be making any major directional movements till we get clarity on these two issues. The NASDAQ market is looking quite a bit different from the broad market, and as I mentioned beginning of last week, if I didn't know about Syria and the fact that the Feds are only weeks away from cutting the stimuli program, I would think we're still in a very bullish market. We're trading nicely above the 50-day moving average, and we filled the gap to the upside. The truth of the matter is we're still only 50 points away from an all-time high, and we have a very high probability that we're going to attack Syria sometimes next week. Based on pure technicals, the NASDAQ is strong. The big question is the broad market going to drag this market lower, or is the NASDAQ going to lift the broad market? Most subsectors made up of non-tech stocks are moving in line with the broad market. However, one subsector that was holding us back a few weeks back was the chip or the semiconductor sector. And today, for the first time, the chip sector is trying to break above the 50-day moving average. If we can get the transports and the Russell 2000 to start breaking above the 50-day moving average, I would tell you that we are bullish overall. But for now, we have to see if the broad market is going to follow the NASDAQ or if the tech stocks are going to test a high and back away as they did 3 previous times. The next resistance level in the chip sector is 3860, and if we can make it past that, we have to watch the 39 level carefully because there's a lot of resistance there. And don't forget about the broad market. It's a very big market and it's very easy for it to drag the NASDAQ down. The US dollar is beginning to reverse after a nice 3-day run-up in price. Most of the buying was a result of increased evidence that economy is in fact improving. Let me give you a quick fundamental analysis so you can see exactly what's happening. If the stimuli program ends, interest rates will go up. And if interest rates go up, people who put money into the US dollar will get higher interest rate on their money. I know this sounds really simple and basic, but that's what it all comes down to. And this is why we had the rally in the dollar the last few days. But now things are priced in, and we still have Syria looming over our heads. We saw a technical island reversal similar to the one we saw in crude oil and gold last week. The next target on the downside is 81.50. The drop in the US dollar caused foreign currencies such as the euro and the Swiss to rally again for the first time in several days. We may see more strength in the foreign currencies till the dollar reaches the support level of 81.50. The Australian dollar is trading up substantially higher today on stronger than expected GDP data. This time, the Aussie is rallying not because of positive data from big trading partner China, but actually because of data from its own country, believe it or not. The pattern we're seeing right now in the Aussie is a double bottom, and this is one of the oldest and most reliable reversal patterns out there. There's a few things I look for when looking at double bottoms. The first thing is how far they're spaced in between. In this case, the setup took over 1 month to form, which is a reasonable time for a reversal to take place. The second thing is the length of the trend before the setup occurred. Remember what I always say, the longer the trend, the better the odds of a range-bound cycle. And the longer the range-bound cycle, the better the odds of a good trend following. In this case, the downtrend lasted for 3 months, which is also a reasonable amount of time for a currency to trend in one direction. Therefore, I'm becoming increasingly bullish on the Aussie. Let's keep an eye and see if we can muster enough volatility to reach the 93 level. If we can start moving down, the big sign will be if we break the second bottom. The crude oil market is looking very interesting right now because technically and fundamentally we're seeing two different pictures. On a technical level, we had an island reversal that was triggered and the reaction was reasonable. However, on a fundamental level, if the US attacks Syria, there's very little doubt that it'll have a substantial impact on supply of oil and therefore the price of oil. So for the remainder of this week, unless we hear something new and totally unexpected, I believe crude will be drifting between the 104 level on the downside and the 112 level to the upside. The key will be how soon we attack Syria and how hard we attack Syria. These two questions won't be answered till next week. So for now, we have to rely on the technicals. And for now, they're telling us the market doesn't know what's next. Because the markets are so choppy the last few days, the only setups I see for today are on low price stocks or stocks that don't have any volatility. So we will skip the setups for today's session. You should know that this usually happens when the stock market is entering a range-bound cycle or is waiting for something, and in this case, we're waiting for Friday's data. Have a great night, everyone, and I'll update you midday tomorrow as usual.